So today we're going to be going over cost behavior and cost volume profit analysis. And the purpose of this lecture is to just describe the different types of cost behavior in relation to production and sales volume, and really describe what cost volume process profit analysis is. And so one of the most helpful things you're going to learn here is the contribution margin analysis. And we're going to go into detail exactly what a contribution margin is and why it's so helpful, and the difference between fixed and variable costs. And then we're going to be talking about different types of diagrams you can use in order to help you analyze profit. And that includes scatter diagrams, high-low regression models, break-even analysis, and CVP charts. And we'll be even going over how to calculate the break-even point. I think this lecture, out of almost every lecture in managerial accounting, is the most relevant to business in general. So if you're deciding to become an economics major, or if you're deciding to become a law major, or any kind of major in business, or even if you're not even a business major but want to start your own business someday, this is probably going to be the most useful because it'll be the foundation of your business plan. So let's talk about different types of cost behavior in relation to production and sales volume. So the cost behavior, it sounds complex, but it's really, really simple. Like, what kind of costs do you have? I'm going to keep it as simple as possible. We have costs that change and costs that don't change. So I want to keep this pretty simple, that there's really two types of costs we're talking about at this level of finance and accounting. And so don't get too hung up in the layers of complexity that can be in a cost analysis. There's just two really simple costs. We have fixed costs and variable costs. And what is the difference between fixed costs and variable costs? Fixed costs don't change with levels of output or input, and then variable costs do change. Good example is your rent or your mortgage or your lease. If you lease a building and pay $1,000 a month, it doesn't change if you use the building 10 hours a day or 1 hour a day. That's a fixed cost. So that cost behavior is fixed. It's not going to change no matter how much you use it or how much items you make. That's going to be true generally if you have an office, if you lease a warehouse, any of that, that's going to be a fixed cost. Your variable costs are going to be things like if you have hourly employees, or if you have materials to develop your products, or your electricity. The more you use it, the more it costs you over the long run. And so we can look at these two costs in order to determine how profitable our company is actually being, and to control our cost behavior. And so just knowing that there's these two types of costs, variable costs and fixed costs, can help us answer a ton of questions about our business, as long as we understand our revenue model as well, including how many units must we sell to break even, how much does income increase if we install new machines. We can do division analysis to determine if one division is profitable if we cut it, or if we should add a new division. What happens if we change income and selling prices, and what if we choose to develop different volumes of product? How will income change if we change the sales mix of multiple products or services? And what sales volume is needed to hit a target income? So if we know that we have a certain income that we want to make for our investors or as a partner, or if you just own your own company and want to make $100,000 a year, you can decide how many products you need to sell to make a goal for yourself. And so, again, excellent topic for any entrepreneur, and something you need to know for business as well. Big picture, it gets a little more complex, where we have these brackets where fixed costs and variable costs stay constant, and then we have accelerated curves when we might need to get a second lease for a certain amount of production. We're not going to talk about that. You'll talk about that more in advanced economics and cost accounting. But for this, we're just going to talk about simple cost behavior analysis within a specified range. And so here's a nice little graph that shows us the kind of the cost behavior. And we can see that fixed costs are always going to be a flat line on this graph. It's always a flat line because they don't change. So if this is our lease for the year, no matter how much output we make, it's going to stay $32,000 a year. Maybe this could be a month. Our variable costs, though, are going to be just like a linear line, a linear chart, where we just say 3x, or here it's 20 per unit, right? So 20x. So this is just a simple algebraic equation at the end of the day, right? We have our chart is just 20x plus 32,000, right? Equals our total cost. And so That's right here. Total cost equals 32,000 plus 20x. This goes back to your algebraic equations of just how to make a chart with a line. And so the idea here is that we have a constant cost for fixed costs, and then we have a linear progression for variable costs. And then this relationship we can see is that this is more of the derivative of the cost per unit, right? Which I'm not expecting to know derivatives for this class, but the idea is that the variable cost per unit stays constant over the specified range, but the total cost per unit will go down. So as you produce more units, your lease becomes less expensive per unit because we're making more units during that. And so this goes back to that some of my old lectures of, I think last class lecture where we ask why is lean manufacturing so important? Well, it's because previously people knew that if you maximize your production per unit, you get the cheapest cost per unit. If you maximize the quantity of output that a factory is developing, because your total cost per unit will go down because your fixed cost per unit is being maximized. But companies are now learning that that's not necessarily the best revenue model because it can lead to decreases in quality or customer specified requests. So still useful to know, right? The more output we have, the less fixed cost per unit. And so a good example to keep this easy for everybody or to keep it relatable is I used to own a recording studio. And my recording studio cost me $1,000 a month to lease, and I bought a bunch of equipment. The equipment in the recording studio would be considered a fixed cost. So let's say I spent $50,000 on a mixing board, drums, guitar, amps, all that stuff, microphones. That's a fixed cost. I bought it. $50,000. That's not going to change. That's how much it cost me to build the studio out. And then I have my $1,000 a month lease. That $1,000 a month lease, if I only have one client for that month, then that client cost me $1,000 to bring in, and from a fixed cost perspective. But if I brought in 10 clients that month, then those 10 clients each cost $100. We can allocate $100 of that fixed cost to them. So our fixed cost per unit goes down as our cost for the client, as our number of clients goes up. And so that's what this chart is representing. But if it costs me $20 to entertain those clients every single day or buy them lunch or coffee, that's my variable cost per unit. That's going to stay constant per day. And so this is we're previously looking at fixed cost behavior. This is just looking at variable cost behavior in relation to total fixed costs, but these are the same charts, right? So I talked about both of the behaviors in this chart. It's showing you here that total fixed costs remain flat. Variable costs, we have just a slope, an upward slope for variable costs, but we talked about all the behaviors in the previous slide. And then mixed costs, of course, are going to have an upward slope as well because they include the variable costs, but those mixed costs will start where the fixed costs begin. This concept is what I talked to you about. I don't expect you to know too much about this slide and the next slide. Just want you to be aware that some costs go up in steps. And so a good example is if you have a factory, some factories will have a maximum output. And so that maximum output for this example is about 700 units. So after you have 700 units in that factory, you need to get a new factory in order to make your next bucket of units. And so your cost will bump in a step kind of fashion as you get your next factory or your next factory. Another good example is employees. Like if you have a salaried employee that you need to develop something or to service a client, like if you have an accounting firm and you need to pay someone $30,000, $40,000 a year to do bookkeeping, they maybe can only take 600 clients in a year. After that, you need to get another bookkeeper. And then that's another example of a step cost. And then we have our curvilinear costs, where these costs that increase when activity increases, but in a non-linear manner. So again, the stepwise cost we have here is where it's very clear where we're making a new hiring decision or a new purchase decision and increase our costs. But these curvilinear costs don't have a variable cost. Really, they don't seem like a variable cost. They really don't seem like a step cost I'm not expecting to test you any questions related to curvilinear costs, but it's just important to know that costs don't always behave in the ways that we talked about previously. It's not always going to be a stepwise cost. It's not always going to be variable. It's not always going to be fixed. Sometimes it's something in between where maybe our first few units cost us, maybe we pay a little more for those first few units per unit. But then after we do 650 units, then we get a discount on the subsequent units. And then and a good example of this is like software licenses, right? Where sometimes like if you own a company, your first 100 Microsoft licenses might cost $100 a license. But if you buy more than 100, you might get a 20% discount on those licenses. And if you buy even more than 100, more than 1,000, you might get a 40% discount. But then if you buy more than 10,000, you might need a team that helps implement that into your company. And so the cost might go up. So the idea is that there's a higher acceleration at the beginning, then it evens out in the middle, where a lot of software companies are meant to serve that middle market. And then if you're an enterprise-wide company, multi-billion-dollar company, you might need to spend a lot more in order to get the premium licenses. And so just know that there's these different kinds of cost behaviors, but what I'm going to be focusing on in the test are fixed costs and variable costs. And this is what you're going to need to know for your break-even analysis. Just know that we also be talking about mixed costs a little bit, but that's just variable costs and fixed costs combined. And then stepwise and curvilinear costs, we're not going to be testing. So feel free to, I'm happy to answer any questions related to that, right? Only thing to clarify here is sometimes mixed costs might have, it might be a certain thing you purchase that has a combined behavior. So a good example is like website hosting. So website hosting, sometimes is considered a mixed cost, where you pay maybe $20 a month to have a domain name. But then if you also expect to have a certain amount of data on that website, there's a variable component of it. So there's maybe $20 a month, but then if people watch more than 100 gigabytes of videos, it might be an extra $10 a month. And it's over a terabyte, it might be an extra $50 a month. So they have components of both fixed and variable costs in them. So just know that costs can behave in any of these ways, but we're really going to be focused on the fixed and variable costs in this lecture. So I'm going to pause here for asking questions. So feel free to ask any questions.